Hey there, welcome to the Guaranteed Retirement Guy Show. My name's John, and we're going to be talking about losing money in annuities. Is it possible? Yes, it is possible, but under certain circumstances, and I'm going to show my screen. I'm going to show you an example of that. So bear in mind, I deal with guarantees. I focus on guaranteed income strategies. And most people, when they reach out to me, that's what they're looking for. They want lifetime income. They want market protection. They don't want to lose any money. And that's exactly what they get. But I'm still going to show you how you could possibly lose, okay? Because yes, you can lose money in an annuity, okay? And not just a variable. So variable annuities, they're tied to the market. Yes, absolutely. The market goes down, you're going to lose money, okay? With fixed annuities like MYGAs, I guess you could lose money if you surrender it and you got surrender charges. But if you never surrender it, you will never lose any money because they don't have any fees. They just pay you a straight interest rate. And if you're making 5 or 6% every single year, that's exactly what you get. So it's a very simple product. But let's talk about other types of annuities, okay? So I'm going to share my screen. Let's just kind of explore this together, all right? So I threw someone in here from Georgia. They got $350,000, and I'm going to start with an income product. Okay, they're going to take income at age 70. So they're going to wait 8 years. They're going to put $350,000 in right now, and they're going to take income, guaranteed income, for the rest of their life. So as far as losing money in the account, I'm going to show you that next. But I want you to see, as far as income, this is what you get. So if you were to choose Equitrust, you're going to get $52,000 a year for the rest of your life based off of 350. Okay, it's just how it works. So if I go in here, I'll show you the workings of that growth that is guaranteed. Then I'll show you the losses. Okay, so if you were to buy this particular one, $350,000 in, they are giving you a 10% base bonus. Okay, so we're taking $350,000. And then adding $35,000 to that $350,000 for the benefit base, not the account value, but the benefit base. So that benefit base, after that $35,000 is added to it, now you got what, $385,000. That $385,000 now is multiplied by 8%. So each year, you see right here, 8% for up to 10 years. So, and it compounds. So then we'll go up here and say, all right, well, what does that look like? Well, you can see the end of the first year. The ending benefit base is $415,000, because remember, 385 multiplied by 8% give you 415. Now you got 415 multiplied by 8%. That equals 449, and so on, all the way down. And so this is a result of 8% compounded growth rate every single year. But they're also giving you a withdrawal rate that's guaranteed to grow as well. And this is in the contract. This is guaranteed. This is contractual. This does not change, okay? This is why you buy it, really. If you're looking for an income product, this is why you buy it. You can see at the end of the 8 years, it's 712 times 7.3, giving you $52,000 a year. Not bad. You're buying a decent pension, like $1.3 million pension for $350,000. Okay, so now let's look at how you lose money. Okay, they're showing you, well, this is what the index has done in the past. You'll probably make that, and your account value will probably grow to this. But who cares? If you take an income, this is what it's based off of, and your account balance is going to run out anyways. Okay, then they show you, here's how you can lose money. See here, 350, look at that, going down to 320. How does that happen? This is under guaranteed values. You notice the income here is the same. It happens because they're showing you worst case scenario. If the market does nothing, your account value is going down because you're paying fees. Look at the fees over here, rider charges. You got like $4,000 a year in rider charges. Okay, eventually they go away because there's no more account balance to take from, but that is what's giving you that 8% guaranteed compound rate is that rider. They're charging you to give you that rate of growth. But because of that, you're getting a lot of guaranteed income and it works out pretty good. But that's how you lose money in an annuity. You lose money in the account balance if there is no growth during that time period where you're waiting to take income. Or if you're taking income and there's no growth, you'll lose the account balance faster. But if you're taking it for income, it doesn't matter. Some people get hung up on this and they're like, well, I hate the fees. Okay, let me show you how not to lose money. Okay, you can just say, I don't want a rider fee. Okay, I just don't want to pay any fees. I still want lifetime income though. All right, well, you can get this income. You can do SILAC, which is B-rated. I wouldn't do that for lifetime income. Or you could do American Equity. So $27,000 a year. So yeah, it's almost like half, right? So it's not great for that. But look at the upside. The upside is see that balance? Doesn't change. Even with the market doing nothing, it doesn't change because there's no rider fee. So there's no way to lose money. And they give you lifetime income. So they're showing you worst case scenario is you get lifetime income and your balance will be done by the time you're 83. But of course, the money goes, the income comes forever. And then you look at the hypothetical growth rates. You'll still get some growth. Yeah, it'll probably grow to $400,000. Not a growth product. Okay, just let you know it's not a growth product. But you still got guaranteed income, and that's nice. But it just doesn't give you as much. So You can either choose to pay like 50, 60 grand in fees or not. I mean, you can see the difference in fees. I mean, if I pay these fees here, the rider charges, I'm going to pay them for a while. I'm going to pay like 50 grand in fees, but I'm getting like almost double. I'm getting like 26, like 26, 25 grand more. So even 25 grand more times 30 years, that's like 750 grand. So yeah, I mean, you might lose money as far as the account value goes right here. But the trade-off is, I guess, you paid 50 grand in fees, but now you get all this income, okay? And you're getting like 700 grand more in net income after paying the fees. So I don't know. My opinion, it's worth it. But that's how you lose money. That is how you lose money. And if you wanted to surrender the contract, it gets worse, okay? Let's say the worst case scenario. Let's say the market goes down, it's horrible, and your account balance is now 332. And you're like, dang it, I have paid all these fees. I do have a benefit base of 565. At least I have that. And if I took income now, it's 565 times 7, giving me 39 grand. Well, that's not bad from this account. But then you're like, but if I want to surrender it, I got 332 in here. If I surrender the thing, what will I get? Let me see. It's like what? 324 cash surrender value? Wow, that's not very good. Yeah, I'll lose that's how you lose money. You're going to lose like $8,000 if you were to cancel the contract. So I'm just trying to show you how to lose money in these, okay? This is kind of going against the grain here, but if you want to lose money, buy an annuity contract, make sure that the index doesn't earn anything, and make sure you have rider charges, and then make sure you cancel it in like 5 years. It's perfect strategy. But if you're looking for highest income, then it doesn't matter, okay? Buy the income rider, pay the fee, and enjoy your life. Enjoy the income, because in my opinion, that's what it's for. So anyways, that is how you lose money in an annuity contract, is if you cancel it early, if you have no index growth and there are rider charges at the same time. That's how you lose money in the account value. But as far as lifetime income, you can never, ever lose money, okay, in my opinion. Just if you're taking income and after a few years, you're going to get all your money back, your principal back. I don't know. You just look at this and say, well, 350 grand, it's going to take me, 7 years to break even? Okay. So I start taking income at this age and I take it till this age. I've gotten all my premium back. And then I got all these years here where it's all gravy. That's pretty good. So yeah, I mean, that's the power of lifetime income. So anyways, if you're looking for an annuity for yourself, I'd love to help you. Go to my website first, check out the annuities that are available. And then if you want to chat, go ahead and book a call. It will be a Zoom meeting and I will share my screen and we can talk about whatever you want to talk about. So if you're looking to purchase an annuity and you don't want to go through all that and you just want to book a call, there's a link below this video. You can go directly to my calendar that way as well. So anyways, I'm happy to help. I'm super transparent. I show you everything that's available. Some of these pay high commissions, low commissions. It does not matter to me. I'm not going to try to push you into one that pays me the most like a lot of other guys do. Unfortunately, that's just what happens in the industry. But it's a lot easier just to show you what's available and then you can make your own decision. So I'll be there to help you, guide you, and take care of the process along the way if that's what you're looking for. So thanks for watching. Appreciate you. If you like the video, make sure you click the like button, subscribe, share, and comment if you have any questions. All right. Thanks again, and we'll see you next time.